story from the project. Innocent black man. Let me be clear. Damn, man. The story from the project. Innocent black.
What up, YouTube? Welcome back to the Small Account Challenge. Today is day number 86. Towards the end of this video, I'm going to be explaining the PDT rule and the difference between a cash account and a margin account. Anyway, let's talk about today. In the pre-market, I saw SPY had gapped up and Meta was kind of sitting where it closed out on Friday. So anyway, I had to wait for the market to unfold it. And when the market opened up, we was able to pull out a green day, not our profit target, but we'll take it. Now I'm going to tell you exactly how we did it. And today, midday, market recap. All right, y'all, so let's go over the trades from this morning. We wasn't able to hit our profit target, but we was able to get about 1%, and we'll take it because we're still heading in the right direction. Our first trade of the day was on SPY to the downside. We won on this one. It was at 937. Let's pull the charts up. We got it up ready on our screen. It should come up on your side in just a minute. All right. At 9:30, when the market opens up, we got a huge sell-off. Remember, SPY had gapped up in the pre-market, so now people taking profits. On the next candle, we continue selling off, and now we're coming down to the 200-day moving average. I know that's a good line of support. I told you that before, so I know it's going to bounce with that, or at least have some activity there. It did exactly that. We jumping on the next candle at 9:37 to the downside because I feel convicted enough that those first two candles have a lot of bids in there and they're going to push it down. We stay in this, it begins to fade back up, but I'm not worried because I have faith in the first two candles. It doesn't reverse the move, and on the next candle, it begins squeezing past the 200-day moving average, and we sell on that push, and our first trade is a green trade. And you know, I like for my first trade to be a green trade. Why? Because I'm not trading from a position of handicap. All right, now. Our next trade was on Meta to the upside at 951. All right. At 9:30, Meta begins selling off. And it's probably selling off because SPY is also selling off because Meta is a part of the top 500 companies in America. And SPY is the top 500 companies. So they normally run lockstep. So anyway, it sells off and comes down to the 200-day moving average. It breaks through that. Remember, we jumping this at 951. It breaks through at 935. The 940 continues selling off. So 945, we get a candle of indecision. So I'm thinking to myself, because of this candle, it might hit some resistance and want to reverse back up. We jump into this as it closes at 951. And what it does, it continues selling off. So we hold for this entire candle at 955. We add, hoping for it to finally reverse back up. And it doesn't. It continued to sell off. And at 10:01, it finally began to sell off. But by that time, we're in the red too much. And we don't want it to reverse against us and put us too much in the red. So now we're sitting pretty red on the day now. We gave back the profits from our first trade. And now we're sitting red on the day. But we still got a lot of buying power left. So we're going to try to trade our way back. Our next trade was on Meta to the upside. So now, on the 10 o'clock candle, we got a green candle. It starts fading back up. At 10:04, we jump into this to the upside, and Meta fakes us out. I hate the breakout fake out. It got us. So we got bull trap on this one. So now it begins fading back down, and we figured, you know what? We're not going to take a bigger loss than we need to take, and we sell at 10:06, and we had to get out of that one before the loss becomes too big and it's too much. I mean, it's too hard to recover the rest of the day. So now we got a green trade in the first trade, gave back the profits in the next trade, and now we're deeper red after the third trade. But we keep our composure. When you're trading in this game after a red trade, you understand it's only part of the game, and you was wrong on your entry. Begin to slow down and begin to read the charts more clearly and begin to snipe and get back in the game. That's exactly what we did on our next trade, which was on SPY to the downside. All right, now here we go. SPY to the downside. I told you earlier, SPY has sold off for a little while, and we get into this at 10:10. So 9:55, it tries to come back up to the 200-day moving average. But I told you that becomes a very good line of resistance or support depending on where the price action is. So at 10 o'clock, it hits it and begins to fade back down. We want to make sure when it continue going down. So 10:10 is continue selling off. We jump into this at 10:05. It continues selling off. We jump into this at 10:10. It begins to fade back down. It wants to reverse on us. So now I'm like, don't tell me I'm wrong on this, but I got conviction because the 200 days acting as a line of resistance. At 10:15, we add to this at around 10:13. It comes to the 10 EMA. It hits it and begins to fade off. We add one more contract and this bad boy flushes. And that's when we make back our money from the third trade that we lost. And now we're sitting break even because we got out of this at 10:17. And now we're break even on the day. So after the first trade we're green, the next two trades were red, and SPY on this one because of the couple of contracts bring us back to break even. I'll take it. And now we get into SPY again on the, we get into Meta to the upside at 10:21. So at 10:20 it sells off because of that candle. I know now because of that huge sell-off, people are going to start taking profits. We jump into this at 10:21 as that candle closes. We ride it up, and that gets us even more green on the day, but we're not holding too much because now we're running out of buying power. So once we see green, see profit, take profit, and get out of there. And we get into one more trade on Meta, and this one was to the this one was right. This one was to the upside. So at 10:31, on the 10:30 candle, it closes red. So now I know we got a little bit of support because them two candles before it. And at 10:31, we jump into this one and we ride it up and we get out on the next candle as it squeezes up to the 10 EMA. And now that puts us in a nice situation for the day. You can see it there, about a little between about 1% right there. You can see it. And that's how we finish today. We'll take it as we climb through the $1,500 level. We're going to keep moving in the right direction. Of course, you know you can't always hit the profit target, but green is better than red. So anyway, y'all, let's get into today's class, which is talking about the PDT rule. All right, y'all. Let's talk about the PDT rule and the difference between a cash account and a margin account. All right. The PDT rule it stands for Patterned Day Trader. And it means that if you don't have a minimum of $25,000 in your brokerage account, you're only allowed 3 day trades within a 5-day rolling period. And this rule was put into place because it wasn't really to attack the small guys. It was really put in place to prevent the banks and the brokers from getting stuck with bad trades from people who lost a lot of money. Because when they give you leverage, if your broker gives you leverage, let's say you have, just for this example, let's say you have $100 and your broker gives you 6 times leverage. So $100 times 6 gives you $600. So now you're able to take positions up to $600 in that account, though you only put in $100. So if it goes in your favor, wow, benefits, everybody's happy. But if it goes against you, and it goes really against you, so now you've lost the $100 plus the leverage that the broker gives you. So now if you don't pay that money back, the broker and the banks were on the hook for that. So they got tired of that, and they put that rule in place and said you have to have a minimum of $25,000 in your account, in a margin account, and you're only and if you don't have that, you're only allowed to day trade 3 times within a 5-day rolling period. Now, what considers a day trade? A day trade is when you change directions, meaning this: you go in, that's one direction, then you come out. That's the next direction. That's one full day trade. So if I buy again, still moving in the same direction, then I sell the entire position. Now that's considered a day trade because I changed direction. Let's say I buy again. I'm still moving in the same direction, but I sell, but I don't sell the entire position. I've changed directions, so that's considered a day trade, but some of my position is still sitting there. So in order to get it out, I got to sell again, and then I consider 2 day trades. So always be mindful of that if you're trading in a margin account And once you change direction, that is considered a day trade. Now, 5-day rolling period, what that means. Okay, if I make 3 day trades on Monday and my account is not at $25,000 minimum, I can't trade again in that account until the following Tuesday. Why? Because Monday was the trade day. So now I have to wait 5 days. So it's Tuesday, Wednesday, Thursday, Friday, Monday, and Tuesday I'm able to go again because, like I said, the pattern day trading rule says you only allow 3 day trades within a 5-day rolling period. For an example, let's say though I trade on Monday, 3 day trades, my account is not at the minimum of $25,000, and the next Monday is a holiday. So on Tuesday, that becomes the 5th day because the banks are closed on Tuesday. Closed on Monday because of the holiday or whatever. So I won't be able to trade until Wednesday because it has to be at least 5 business days. And sometimes the banks are closed and the banks are the one who sell our money. So if the banks are closed, that day doesn't count as a business day. So now, that is a margin account. You're able to have leverage. You can trade with more money because the broker gives you money. The downside is the benefit is your money settles immediately. Meaning this, for an example, let's say I have a $5,000 in my margin account, and I take a position of $5,000, and I sell. That $5,000 is ready to sell again. Buy again immediately because in the margin account the money settles immediately. But like I said, after the 3rd day trade, you're done. Now, let's talk about a cash account, which is the account that we have in our Webull account. A cash account allows you to trade as much as you like to trade. The downside is once you are out of cash in that account, no more trades until the money settles. So for an example, if I have $1,000 in my account, I can take as many trades as I like up until $1,000. Once the $1,000 is done, I can't trade no more that day because the money has to settle. The good thing is this. Recently, I think it was in 2024, they changed the settlement time. Years ago, it was T plus 2, which means is the trade day plus 2 more days. So if I traded my full $1,000 in that account on Monday, I had to wait that day plus 2 more days before the money would settle. So if I traded on Monday, that's the trade day plus 2. Tuesday, Wednesday, then the money would settle on Wednesday and I could trade again on Wednesday my $1,000. But they changed that recently. Now trade settlement is T plus 1. So what that means is I can trade my full $1,000 on Monday and the bank will settle it by Tuesday. And on Tuesday, my $1,000 is ready to trade again and I can trade again in that account. So that's what makes this so good. It's because I can trade in my account. I can trade the 1,500 and by Tuesday ready to go again. Now I both like the cash account because I don't got to worry about margin and margin calls. I forgot to explain that. Now, if you break that rule of going past 3 day trades and your account is not at the $25,000 minimum, your broker will issue a margin call on your account. So let's say you have $6,000 in there. You go in more than 3 times. You buy, sell, buy, sell, buy, sell. You're done for the day. You're done until the next the 5 days passes. But you get crazy and you're emotional and you trade again. Now you committed a margin call, which means is your broker is going to email you or call you and say you need to put a minimum of $25,000 in your account or we're going to shut your account down. And you're only going to be able to close trades and not open them no more because you've broken the rule. Now, what they'll do sometimes, not in all cases, sometimes they'll say, we broke the rule, we'll give you a pass one time. You break it again, now that's on you. So this is why I like a cash account, because a cash account, I can trade as much as I like until my cash runs out. So that means I got to be more strategic in my trading, and at the same time, I have built-in breaks in my account, meaning once my cash is all out and I could be emotional, lost a lot of money today, but you're done, your cash is out. Come back tomorrow with your emotions settled, and that's why I like the cash account. So that is the difference between a margin account and a cash account, and that is the PDT rule. So respect that and don't go against it, because these are the rules you got to play by. When you play this game, you got to play by the rules. Hopefully one day the SEC decides to remove that or give it some leverage, meaning something like where you show consistency in your account, and now they give you a little bit more leverage to trade a little more freely. If not, keep using the cash account and grow your account to where you want it to be, maybe $25,000. Then move it over to a margin. Me, if I get $25,000, I'm staying in the cash account anyway, because I don't need that many trades to make my little 2 or 3% and keep moving forward. Anyway, that's all I got for you today, y'all. And I'll be back at this tomorrow for day number 87. All right, y'all. Peace.